When managing personal finances or running a small business, many individuals opt to handle their accounting themselves to save money. While DIY accounting can seem like an appealing option, it often comes with challenges that can lead to mistakes and costly consequences. From failing to track receipts properly to misclassifying expenses, there are several pitfalls that can arise in the process. In this video, we'll explore the top 10 common pitfalls in DIY accounting and provide tips on how to avoid them to ensure your finances remain in good shape. 1. Not keeping track of receipts. One of the most common mistakes in DIY accounting is failing to keep track of receipts. Without proper documentation, it becomes challenging to back up expenses during tax season or if your finances are audited. Whether it's a small coffee purchase or a large business expense, not retaining receipts can result in losing out on valuable deductions or facing difficulties in justifying expenses. To avoid this, make it a habit to store your receipts in an organized manner, either digitally or physically, and ensure they are categorized appropriately. 2. Misclassifying expenses. Another frequent error is misclassifying expenses. This can happen when you confuse personal expenses with business expenses, or when you categorize purchases in the wrong accounting category. Misclassification can lead to inaccurate financial reports, affecting your tax filings or business analysis. For example, mistakenly categorizing a capital expenditure as an operating expense can skew profit margins. To avoid this, be diligent about learning the correct categories for different types of expenses and ensure consistency in your accounting records. 3. Failing to reconcile bank accounts. Failing to reconcile bank accounts regularly is a critical mistake in DIY accounting. Reconciliation ensures that your recorded transactions match the transactions that appear on your bank statement. If your accounts aren't reconciled, you could miss discrepancies, such as unrecorded fees, missed payments, or fraudulent transactions. To prevent this, make a routine of reconciling your bank statements with your records monthly, and address any discrepancies immediately. 4. Not keeping personal and business finances separate. For small business owners, mixing personal and business finances is a significant pitfall. When personal and business expenses are mixed, it can create confusion during tax time and increase the risk of audits. It can also make it difficult to understand the financial health of your business. To avoid this, open a separate business bank account and credit card to ensure all transactions related to your business are distinct from personal expenses. 5. Neglecting to track depreciation. Depreciation is an important factor in accounting, especially for businesses that own equipment, vehicles, or property. Failing to track depreciation accurately can lead to overstated profits, which may result in higher tax liabilities. Depreciation should be recorded over time according to the IRS guidelines. Consider using accounting software that includes depreciation tracking or consulting with a professional to ensure you are accounting for depreciation correctly. 6. Underestimating tax obligations. A common pitfall in DIY accounting is underestimating tax obligations. Without a comprehensive understanding of tax laws, you might fail to set aside enough funds to cover taxes or miscalculate deductions, leading to unexpected tax bills. To avoid this, stay informed about your tax responsibilities and use tax estimation tools to periodically review your estimated tax payments. Setting aside a percentage of income for taxes can also help ensure that you aren't caught off guard when it's time to file. 7. Not using accounting software. While some DIY accountants prefer to handle everything manually, this can be a risky approach. Handwritten ledgers and spreadsheets are prone to errors, especially as transactions increase. Accounting software can help streamline the process by automating calculations, tracking expenses, and producing financial reports. Many accounting platforms also come with templates for taxes and reconciliation. Using accounting software reduces the chance of human error and makes financial tracking much easier and more accurate. 8. Failing to plan for future expenses. DIY accountants sometimes focus only on the present and neglect to plan for future expenses. Whether it's preparing for a large purchase, upcoming taxes, or potential business expansion, a lack of forward planning can leave you financially unprepared. To avoid this, regularly set aside funds for future expenses and create a budget that accounts for both short-term and long-term financial needs. Planning ahead can help avoid cash flow problems and ensure your financial stability in the future. 9. Overlooking tax deductions and credits. Many DIY accountants fail to take full advantage of available tax deductions and credits. There are a variety of tax benefits that you might be eligible for, such as home office deductions, educational credits, or business-related travel expenses. Missing out on these can result in overpaying taxes. To avoid this pitfall, research available tax deductions and credits carefully and keep detailed records of all potential claims. Seeking guidance from tax experts or using reliable tax software can also help ensure you're maximizing your savings. 10. Failing to maintain consistent records. Consistency is key in accounting, but DIY accountants often fail to maintain consistent records, especially when dealing with sporadic transactions or changing accounting methods. Inconsistent entries can lead to confusion when preparing reports or filing taxes. To avoid this, create a consistent routine for recording all financial transactions and stick to it. Make sure all records are kept up to date and filed in an orderly manner to ensure that they can be easily accessed when needed. DIY accounting can be a rewarding way to manage your finances, but it comes with its share of challenges. From failing to track receipts properly to misclassifying expenses, the potential pitfalls can have long-term consequences if not addressed. However, by avoiding the common mistakes outlined above, you can ensure that your accounting is accurate, efficient, and in compliance with regulations. Whether you're managing your personal finances or running a small business, being mindful of these pitfalls and taking proactive steps to avoid them will help you stay on top of your financial situation and make sound decisions for the future.